So, what in the world happened yesterday? What was that? Why it felt so painful? More than we used to in red days. But more importantly, how this collapse we've seen yesterday can lead to a massive opportunity to make a lot of money for smart investors. So before we go through that, I would like to take 5 seconds of your time to talk about something personal. A story about how I started on YouTube. And by the end of this story, you'll see how it connects to what I'm talking about here. Now, some of you know this, some of you may not know this, but as an immigrant kid, I came to the US and never imagined of reaching the highs I've reached, which is working for a financial institution of the highest degree, a degree from the University of Michigan, one of the best schools in the world, working for 10 years as a senior manager for Deloitte. I mean, I had a terrific opportunity to experience the financial system up close. And for a Russian kid, that was incredible. And when I got burned out, and I knew I was burnt out, I was already financially comfortable. I was smart with my money. I'm not a huge spender. I had plenty. For my lifestyle, I had enough. So I didn't really need a job. But I decided to do YouTube because it seemed like fun, like a little side project. It was COVID. I was bored. And I dove into the world of financial online media. And I was shocked. Look, I thought I was surrounded by sharks and nasty people when I worked in investment banking, when I worked for Deloitte. I thought I saw some backstabbing, some craziness, but this is absolutely nothing compares to what financial mainstream media and financial social media is doing to its own viewers. This whole thing dwarfs whatever I've seen in the actual financial industry by eons. Look, allow me to explain. This, what we've seen yesterday, is a correction. And corrections happen all the time. We'll talk about that in a second. But the level of insanity that mainstream media has drawn from this, the level of fear, panic, the level of anxiousness, oh my God, the world is ending YouTube videos from financial influencers. This has gone to a whole new level. And I'm going to step in here and I'm going to use the same tactics they use, the clickbait, to get you to watch a video that contradicts everything you hear about this. So yes, this video is titled probably something like, "The world is ending 2024. I get it. Because otherwise you don't click. But now that I got you here, please listen because I'm about to say something that is completely contrarian to everything you hear on mainstream media and social media. I'm going to save some people from horrendous, horrible decisions out of emotional anxiousness. And I'm going to do that by explaining what happened, why it feels worse than it really is, and how you can use that to make money. So I'm going to do my good to counteract the BS you're seeing on YouTube and mainstream media right now. So let's talk about it. Now, what I do on this channel ultimately is help everyday people like you, like me, I'm not different than you, to get to financial success through investing. Now, the problem here is that there's a lot of emotional distractions that interfere with that goal I have. And my goal is for all of you to make money. But you have to understand that there's a lot of sharks in the water. On the one hand, Wall Street wants you to panic and they want you to get excited. They want you to buy at the top and they want you to sell at the bottom. And they want to keep doing it every time so they can make money, so they can have their Porsches and the Ferraris and the Lambos. Now, look, I don't drive a Porsche, not a Ferrari, not a Lambo. I drive a 5-year-old beat-up car, and I'm happy with it. I don't need that. But they are there to get you. For them, you're pigs. Pigs being led to the slaughter, and they are the wolves. And the main culprit to what they're doing, and it's important to understand that, is mainstream media. Mainstream media is in full cahoots with those people. Not officially. They don't have a deal to screw you over. But there's a clear understanding that what mainstream media does is create panic when stocks drop so they can get clicks and ad revenue money and attention, that way pushing the agenda of Wall Street to buy cheap, and when the stocks hit the top, they push euphoria. Again, for you to click, they make the ad revenue, Wall Street sells. And they repeat that cycle every few years. There's new people that join the market every few years and they do it to them again. New suckers, new victims. Now, I'm going to counteract this whole thing with one simple video. And today, it's going to be very, very simple. Now, look, unlike this media noise you're hearing right now, unlike the end of the world YouTube thumbnails, which actually have end of the world YouTube videos, not like my clickbait. The YouTube, oh my God, this is the apocalypse, this is over, and all this crap. This is a market correction. A market correction is way more common than you think. And smart investors use market corrections to make money. And after this video is over, you probably will be able to do the same, should you choose to do so. So over the past week, we have seen the S&P 500 drop 3.2%. Tesla is down 14%. Crowdstrike is down almost 30%. We got TSMC down 9%. Google down 5%. Nvidia is down 6%. Palantir, my love, is down 6.5%. So the markets are currently on the pullback, on a correction. Now, allow me to explain. A 3.2% drop in the S&P 500 is not even the definition of a correction. A correction is a 10% correction. That happens every other year, according to the statistics we have in front of us. In the past 20 years, half the time, 10 out of 20 years, had a 10% correction on the S&P 500. So every other year, the S&P 500 drops 10%. It's normal. Now, what's not normal is that didn't happen since 2022. Not in 2023 and not this year. We still didn't have a 10% correction. So what's the outlier here is not the correction, is the fact that it took 18 months and we still don't have it. We still are only on a 3.2% correction right now. Even if you measure from the peak to the trough and you go and you measured it, and I'm going to show it right now. Let's measure from the peak to the trough. So S&P 500 at the peak, right, was at 567, right? That's on my notes. July 16. That's the peak. Right now with 4,500. That's a 4% drop. Even if you go and you stretch it out and you measure peak to trough, not the last week, it's down 4%. So we're not even in correction territory yet. So this is nothing. I know some of you have joined the market over the past 6 months and you think this is a correction. It's not. Now, the other thing I want to show you here is history and data, not emotions and gut feelings. When you have gut feelings, go to the toilet. Look, the S&P 500 over the past 96 years until the end of 2023, let's use the end of 2023 as a cutoff date. So we're not going to do this mid-year, right? So if you measure 10 years in those 100 years from whatever point you want, so 10-year increments after 1 year, after 2 years, after 3 years, after 4 years, in a 100-year era, well, 96 to be honest. So there's a lot of 10-year periods in those 100 years. You know the crazy part about it? 96% of the time, those 10-year periods, wherever you place them on the 100-year spectrum, 96% of the time, you will have a profitable year in the S&P 500. 96% of the time, a decade inside the S&P 500 for the past 100 years is positive. Now, you can debate all you want about the index funds being dangerous, but a 96% on a 10-year investment is not a dangerous thing. You can't tell me that. Now, the average S&P 500 return for the past 20 years is 9.5%, which is normal. We all know this by heart, right? 10% S&P 500, fine. But if I take out the best 10 days for the past 20 years, so basically I remove 10 days in 20 years, the best 10 days, I pick and choose and I remove them. That return drops from 9.5% to 5.3%. By removing only 10 days in which you're not going to be in the market for whatever reason, your return drops from 9.5 to 5.3. By half, Eddie. I want half, Eddie. Half. 10 days in 20 years. The crazier part, if I remove 20 days, if I remove on average a day per year, and I just choose the best days, that return drops from 9.5% to 2.6%. If I remove 30 days, the 30 best days in 20 years, you made 0.4% in 20 years. Congratulations. But why did yesterday felt harder and more painful than regular red days we've seen over the past few months? Because we did have red days, right? But this one felt extra. Why? Well, number one, the S&P 500 dropped 2% on a single day. That hasn't happened since February of 2023. Number two, the NASDAQ dropped by 4.6% on a single day, which is very painful. And if you measure peak to trough, July 10th which was the peak for the NASDAQ, was 500. We're down 8% from that. That is very painful. Now, the MAX 7 dropped 5.6%. It's a lot. That doesn't happen a lot. The last time these stocks dropped more than 5% in a single day was in 2022, a long time ago. Before that, 2020. This is not a common thing. So we did have a strong correction, 100%. So now the question is, what should you do? We understand what happened. We understand why it felt way more painful than the usual common red day. But what do you do now? How do you make money off of this? Well, let's use facts over emotions, shall we? Okay. So look at my portfolio. From January of 2023 until yesterday, I was up 160%. 160%. My portfolio is extremely simple. Palantir 40%, S&P 500 40%, Tesla 20%. I was up 160% on my portfolio in 18 months. Now, if you look at the videos I've done on the channel since January of 2023 until now, in the past 18 months, I have covered 9 stocks, all of which got a bullish rating from me. Now, those 9 stocks are Google, Tesla, Palantir, Crowdstrike, Bungie, SoFi, ANET, SMCI, and NVIDIA. All of these stocks were green. All of these stocks were green. Not a single one was in the red. The average return was 123%. So not as good as my portfolio, but 123% in 18 months, that's some good content right there. Even the S&P 500 on its own did 41% in 18 months. The NASDAQ did even better, 80% as of January 2023. So if you measure this on a monthly basis, over the past 18 months, the S&P 500 gave you 2.2% per month nonstop, and the NASDAQ gave you 4% per month nonstop. That is literally double than the normal for a year and a half straight nonstop. Now, do you think that lasts forever? Do you think this can continue into eternity without corrections, without pullbacks? I mean, the market doesn't work like that. If you joined 6 months ago, it sure seems like it, but it's not how things work. If you have 18 months of insanity, it's going to end up with a correction, with a pullback. It's healthy, it's normal. It happens all the time. Now, look at a stock like SMCI. And this is the point where I want to make here, that you should watch these videos. I make them for fun, but they have a lot of value. Look, when I spoke about SMCI for the first time back in August of 2023, and I said, look, this stock at $253 is insanely undervalued. In fact, the title of the video was, I'm buying this over NVIDIA. Now, obviously I wasn't wrong. So the stock climbed all the way to $1,200 from $253. That's 374% in 6 months of profit. Now, what did you do with this profit? Now, once you do 374% in 6 months, it's kind of obvious that you are in a parabolic euphoric spike and it's not going to last forever. That is why in March of 2024, at about $1,000 per share, not at the top, I don't time the market, but when this thing hit $1,000, which is 4 times more than my initial video, I was like, guys, this thing ran its course. I literally posted the video in March of 2024, go back and check me saying, hey, is it a good idea to buy SMCI at $1,000? And in that video, and you'll see a clip in a second, I said very straightforward things. Check it out. This company actually builds the servers that house the NVIDIA AI chips. The same AI chips the entire market is going gaga over. Well, these chips have to go into certain servers. These guys build the servers. That's why I like the correlation to NVIDIA stock back in August. But at some point, because they don't really have a moat, at some point, somebody can come along and build similar servers at cheaper. It's a huge problem you have to be aware of. It's a massive, massive risk. That's why I think this company is not the next NVIDIA. They don't have the know-how, the IP, and the protections and the moat of NVIDIA. That's not the next ASML. You have to be very, very careful. Don't be confused. Don't go all in at one price point. Don't get excited and buy into a parabolic spike. That's not how you do it. Wait for some weakness before starting opening a position. As you just heard, I told you, this ain't NVIDIA. Don't buy into a parabolic spike. Wait for weakness to open the position and make sure you understand that these guys have no moat which means they're not the next NVIDIA. There's a lot of risks there. I gave you a warning at $1,000 saying, hey, this thing is running up way too hot. Now, whether you sold it or kept it or bought it, it's your business. But on this channel, you got a warning. This is literally like the Kenny Rogers song. You got to know when to hold them and when to fold them. When something runs up 400% in 6 months, it's probably a good idea to start thinking about taking profits. I literally told you this in the video. I gave you a warning. Now, at this point, this is water under the bridge. It's in the past. Who cares? Now, we're talking about a whole new enchilada, a whole new situation. Right now, SMCI stock, same stock that was trading at $1,200 when I made my video telling you, hey, be careful. Now it's trading at $700, which is a 40% discount from the peak. Now it gets interesting again. This stock right now, if you want to be a part of it, if you wanted to DCA into SMCI, and it's your decision and your analysis, but if you like the stock, this is a better stock at $700 than it was at $1,200. So instead of FOMOing into a parabolic spike, wait until weakness and start dollar cost averaging into the stock, just like you can do here with SMCI. Now look, I'm not telling you to buy or sell. This ain't financial advice. For the love of God, understand that. But I'm using this as an example to show you how FOMO and emotions can work both ways. And look, if you don't want to get rattled by a day like yesterday, you got to have a plan. You have to understand what are your goals, where are you trying to get, so you don't get mad, you don't get anxious, and you don't panic. If you are a trader, right, it's probably not a great environment for you right now, right? You have to think about stop losses. You have to think about, letting go of some of the losers to manage your portfolio. Traders is one thing, and this is a very volatile time for them. Probably not the best days to be a trader if you had long positions. But if you're a long-term investor, if what you do is invest for the next 10, 15, 20 years, this is a kid in the video game store situation, because right now you have so many options to dollar cost average and open new positions or reduce the cost on your existing positions on such great companies. This is a bad time to be a trader, but a really, really good time to be a long-term investor. We'll talk about one specific stock in a second, which I really like out of this list. But let me show you, right? Tesla is now 10% cheaper. I got it in my portfolio. I'm not going to reanalyze Tesla for the thousandth time, right? Palantir is down 6.5%. NVIDIA, the entire Max 7 is down. The S&P 500, the index, if you want to get in the index, that's down like 4%. The NASDAQ is now 8% lower than the peak. TSMC and ASML, the two leaders of semiconductors, are way, way cheaper, like 10% cheaper. Crowdstrike is now down 30% in just a few days. So let's take a look at Crowdstrike as an example of how you can make money because of sentiment, circumstance, and days like yesterday. Now look, Crowdstrike is a stock we've been covering here since 2021 for a long time. It ain't new. In fact, from my previous video until now, despite the 30% drop, it is still up 70%. Now, this company has absolutely a whirlwind of issues to deal with right now. Hearings, lawsuits, compensations, 100%. Is it a career ender for this company? Is this a company-ending cataclysmic event? Hell to the no. It's not going to happen. Sure, they take some damage, but this thing is far from being in danger of closing or shutting down or losing their dominance in the market. Look at their numbers. The company had 35% increase in revenue the past year, 186% increase in net income. It has 5 times more cash than debt. I'm looking at this and I'm saying, so the stock dropped 30% where the entire business is exponentially doing better than the year before. And it's already a global leader, almost a quasi-monopolistic leader in its industry. Think about it. If CrowdStrike wasn't a monopoly, would a little software update from CrowdStrike shut down 70% of the Western Hemisphere? You have to understand how big this company really is. What's the magnitude of what they do, given how insane a result one little software update had? They'll get out of it. So my price target, based on the 5-year model, is in the bear case, $614. That's a 140% increase. $750 in the mid case, which is a 190% increase, and $886 in the bull case, which is a 243% from today's $258 price tag. Today, because of all the negative sentiment of CrowdStrike and the negative sentiment in the market, everything creates the perfect opportunity where this company, which has always been trading at a premium, is now 30% cheaper despite having some of the best fundamentals in the market. That's a money-making opportunity. Thank you. I'll see you in the next one.